And the fifth mistake that I see business bookkeepers, why do I keep saying business owners? Lord, y'all. Business owners are on my mind because it's early in the year and we want to get all the things done. And I have a whole slew of things to do. But I needed to get y'all this video because I recorded it last week without audio. Anyway, hey y'all, this is Sherelle Martin with Nitram Financial Solutions, where we teach bookkeeping without boundaries. So today I wanted to talk to you about something that happens a lot in the space of bookkeeping when people are new to the space. They don't know the foundation behind bookkeeping. They don't know the accounting foundation, and they think that they could just come in and just pick up the books and pick up the software and just hit the ground running without any knowledge of anything accounting related. And so what I wanted to share with you is 5 mistakes that I see bookkeepers make, because it's the top of the year. It's time for people to start getting their books in order. Then there's a lot of you out there who have not done their bookkeeping all year. So you're scrambling to try to find someone to get your books done in time to file your taxes. And so these mistakes often come up a lot, especially when we get clients who need cleanup work, and these are some of the things that we see. These are not the only mistakes that bookkeepers make. There are a ton of them out there. But these are kind of the ones that I see the most often, and the ones that I see that are more detrimental to someone who's new into the space of bookkeeping. So 5 mistakes that bookkeepers make. And they are, the first one is that they don't tell clients to stop commingling their funds. And when I say tell them to stop commingling funds, I mean, you have to be a little stern about it. And so what happens is that because small business owners feel like, this is their business, this is the money that the business makes is their money, they tend to take owner's draws all the time, or they're spending, paying for things out of the business bank account that are personal related. And what happens is, if that continues on, besides the fact that the IRS can come in and take a look and shut the whole business down, it creates a muddle of a mess for the bookkeeper to clean up, because now you have all types of things going through that shouldn't be. You're trying to run everything through owner's draws. And in some instances, that account can grow astronomically. And what many business owners fail to realize is that if you've taken out more draws than the business, if you've taken draws out of the business that are worth more than what the business is worth, more than the income that the business made, that becomes taxable income. So all this stuff you see online about how you can take distributions because they're not taxable is true to an extent. I'm not getting into the tax law because we ain't talking about taxes on here. But what I want you to know is that if you continue to take out distributions in a way that exceeds the value that the business is worth, exceeds the amount of money the business has made or money that you've put into the business, and it creates a negative equity, that money can become taxable. And so as a bookkeeper, you have to be really strict and stern about speaking to the business owner about how to stop doing it. And come up with ways for them to be able to take money out in distributions and pay themselves in a way that doesn't suck all the money and all the cash out of the business. It's one of the biggest reasons why most businesses don't have any cash. And they're like, how come I made all this money and don't have any cash? It's because they took them all out in owners' distributions. So not explaining this to the business owner and helping them figure a way out of how to stop doing that and still keep the business going is number one, is a mistake. And these mistakes are not in no particular order. I forgot to give that disclaimer. They can happen. It's not like the top 5 and that's the number one. There's tons of them. These are in no particular order. The second mistake that I see business owners make, bookkeepers make, is that they don't have clear standard operating procedures on how things are going to be done. They're kind of just going in, doing things willy-nilly, doing some things on one day, doing something different on the next day. They don't have a clear set of processes and policies and procedures on how they're going to help business owners get their books up to date, reconciled, financials distributed, changes made, final financials distributed, so that the person can use the data in them to make decisions in their business and or file their taxes at the end of the year. So not having any clear set of processes on how they're going to function, allowing people to just throw things at them and then they're kind of, trying to just get it all done. That you need to have clear processes clear processes around how you will process accounts payable, how you will process accounts receivable, how you do the bank reconciliations, how you prepare, review the financial statements. You need to have clear processes on how all of that gets done so that you can do the work in a more efficient manner, and not just haphazardly. The third mistake that I see business owners make is that I keep saying business owners and it's bookkeepers. So the third mistake that bookkeepers often make is that they don't understand the difference between cash basis versus accrual basis. This is a big one because bookkeeping is based off of accounting. Accounting is the foundation. Accounting is based off of GAAP. GAAP is the acronym for Generally Accepted Accounting Principles. GAAP is an accrual basis method. Many businesses are accrual basis if they have inventory, if they have receivables and payables. Some industries are required to be accrual basis, others are not. Cash basis is a tax basis. So that means that if a business is cash basis, it means that they recognize income when the money moved. They recognize cash when it comes in the door. They can deduct expenses when they go out the door. Under the accrual method, it means that they recognize money when it's earned, whether they received it or not. And they recognize expenses when they're obligated to pay it, whether they've paid it or not. So many bookkeepers don't understand the difference between the two, and they're saying the business is cash basis, but they have receivables, or they're saying the business is cash basis and they have inventory, which means they have to be accrual basis, or they're saying that they're accrual basis when on their taxes, they're actually cash basis. So not understanding what they mean and when one applies, because a business can operate, and it is in my opinion, that a business can operate under an accrual basis method to manage the day-to-day activity of the business, but their tax return might still be cash basis. So even if they have receivables and payables on their books, their tax return still might be cash basis. And so you need to understand the difference between the two and how to convert from one to do. Some softwares have just a click of the button, so you don't have to calculate it, but there is a method to calculating how to get from one to the other so that the person is not paying income taxes on money that they haven't even received yet, right? And so understanding the difference between the two is key. The fourth mistake that bookkeepers make is they don't understand how to analyze the data. So you're just recording information into the system and not taking the time to go back and look at it to make sure that it was recorded correctly, using the data to help the business owner make decisions. So being able to analyze it and look at their financials and explain why they have a profit when they don't have any cash flow, explaining where on the balance sheet all their money is tied up into, right? Looking at analysis, looking at data from year over year or month over month, and being able to identify the variances and explain them to the business owner, or know when to ask questions of the business owner of why a variance is that way. So not understanding how to analyze the data is a mistake that business owners make. And it's one of the things that why people put us in a bucket of data entry, which is a pet peeve of mine, is that we're not just doing data entry. And so the idea for me behind Bookkeeping Without Boundaries is that you need to know how to not only record the data, but also know how to analyze the data and help the business owner make decisions off of the data. Our audio. Anyway, the fifth mistake that bookkeepers make is that they don't know how to analyze cash flow. And so the difference between analyzing cash flow and analyzing the other data is a small difference. But the point of analyzing cash flow is to help the business owner determine when, at what point, that they need to make decisions, make changes that are going to affect the cash flow. Being able to help them identify at what point they potentially might run out of cash. Whether it's 2 months, 3 months, 6 months, a year from now, as a bookkeeper, you need to be able to know how to pull that data and information together so that they can be able to make the decisions that they need to make to help keep their cash flow going in the business. If they're hemorrhaging cash flow, you need to be able to help them identify where the money is leaking out at and how to plug up those holes. Those are 5 mistakes that bookkeepers often make. They don't tell business owners when to stop co-mingling their funds. They don't use SOPs to help create efficiency within their bookkeeping processes. They don't understand the difference between cash basis versus accrual basis, which can have a major impact on a business's tax liability. profitability, they don't understand or know how to analyze the data, and they don't know or understand how to manage cash flow. So these are the 5 mistakes that bookkeepers make. Again, these are not the only mistakes that are made, and I might do another video at another time on 5 additional mistakes that bookkeepers make, but I wanted to share those with you because those are kind of what's happening really on top of my mind right now, and I wanted to share those with you today. So those are your 5 tips for today. If you like, please follow and subscribe. Click the like button and subscribe below, and please feel free to share it with your network, and I will see you guys next week with Bookkeeping Without Boundaries.